But in terms of manipulation, you're saying about the manipulation of gold and silver, some people might say, well, if they've been manipulating it, how come the price is going so much higher? And my retort, or my answer to that, is that they try to keep the public scared of going into gold and silver, because sometimes they come in and they smash the price and they create a lot of volatility. I think people are waking up to the fact that the only real way to own gold and silver is to buy the real thing. And I think the billionaire there, Mr. Bateman, is an example of that.
Investor David Bateman publicly added another 800,000 ounces of silver, 7,000 ounces of platinum, and 4,300 ounces of palladium, reinforcing confidence and renewed interest in physical bullion. Silver prices surged to their highest in almost 14 years on Wednesday, aided by worries about U.S. tariff policy, signs of tightness in the spot market, and growing investor interest in alternatives to gold. Several catalysts could propel silver significantly higher in the coming months, potentially driving prices to new nominal highs above the 2011 peak of $49.80. Global macro commentator and gold advocate Mario Innecco underscores that the Hunt brothers turned to silver in the 1970s as gold was restricted, anticipating inflation after Nixon closed the gold window. Innecco emphasizes that owning physical metal is the only real protection, and points to billionaire investors like David Bateman as recent examples of high-net-worth individuals opting for tangible metals. Regarding price manipulation, Innecco says the goal is to scare retail investors away from gold and silver through artificial volatility. From an investment perspective, rising silver prices could undermine confidence in the US dollar. Thus, price suppression is attractive for central banks. Additionally, silver's industrial applications create further incentives for its controlled pricing. In his outlook, Mario Innecco agrees with Andy Schectman that physical delivery is the true threat to the paper-silver system. He states COMEX makes it hard for smaller players to take delivery, citing Rafi Farber's failed attempt. Financial institutions face mounting pressure to convert leveraged, unallocated silver positions into deliverable physical metal. This conversion process is becoming increasingly difficult as physical supply remains constrained relative to the paper market size. Shifting to macro signals, Innecco says rising silver prices and Japanese bond yields warn of major financial stress. He notes past silver spikes aligned with crises in the 1970s and 2011. Japan's debt, inflation, and political shifts may fuel higher Japanese government bond yields, risking broader global bond market turmoil. Before we dive into Mario Innecco's sharp insights from their latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
Back in the 70s and 80s, the Hunt brothers were the main guys who went into physical silver. They started actually buying futures in the early 70s and taking delivery in the early 70s. And I suspect it's because when Nixon closed the gold window in 71, they knew what was coming in terms of inflation, but they couldn't buy gold, so they started with silver. But then they got over their heads a little bit, and the regulators and the Fed came after them. But when you have dozens of not small, of course, they're billionaires, but dozens of people with a lot of wealth, and maybe half of them start buying silver like that, it could make a huge difference. And I agree with Andy Schectman. I've been telling people ever since I started following gold, when I bought my first Krugerrands in '02, I noticed that the markets behaved in a funny fashion, like they did the same thing at a certain time every day, which is unusual for markets. And then I discovered GATA, Gold Antitrust Action Committee, and Bill Murphy. And that's one of the things he said. Physical, you need physical, you need to take delivery. But on these exchanges like COMEX, unless you're a big fish, they're not going to make it easy for you to take delivery. I think 2 or 3 years ago, Rafi Farber with a few other guys tried to take a delivery of one contract of silver, which is 5,000 ounce bar, and they made it so hard they had to give up in the end, So yeah, it's definitely the kryptonite taking delivery, and I think it was one of the reasons why they created because the bankers are behind these ETFs. They created the gold ETF. I think it was '04, if I'm not mistaken, and they created SLV as well because that basically makes people not go for physical because people want convenience and they don't want the hassle of buying. For some reason, people are think it's a hassle to buy physical gold and silver, which I think is crazy, but that's what it does. And I saw that today on X, someone came out that a company in Japan called Tanaka Precious Metals. They had a program where you could buy physical silver, I think, and keep it in their vaults. And now they're saying that as of December or like when the program ends, you're going to get your cash settlement, not physical. So it's really difficult to trust all these ETFs and things like that. But in terms of manipulation, you're saying about the manipulation of gold and silver, some people might say, well, if they've been manipulating it, how come the price is going so much higher? And my retort or my answer to that is that they try to keep the public scared of going into gold and silver because sometimes they come in and they smash the price and they create a lot of volatility. And I don't know if you've seen this, Jesse. Back in the 70s, there was communication between the London bullion dealers and the U.S. Treasury and also the State Department about the coming legalization of gold on January 1st, 1975. And one of the dealers in London said, yes, the creation of a futures market should help keep Americans away from hoarding physical gold because it's going to create a lot of volatility and the futures market is going to dwarf the physical market. So that's how they do it. But yeah, I think people are waking up to the fact that the only real way to own gold and silver is to buy the real thing. And I think the billionaire there, Mr. Bateman, is an example of that. Silver, I guess the reason why I said that is because the last time, the only two times silver went to around $50, back in the late 70s, early 80s, we saw almost a breakdown of the dollar system. We saw the US Treasury issuing bonds in Deutschmark and Swiss francs. They were called the Carter bonds. So that was like I think a signal that things weren't well, and silver, having been the money of the masses for thousands of years, reflected that. And the same thing, I guess, in 2011, we saw the European sovereign debt crisis in the countries of the south of the EU, like Portugal, Italy, Ireland, Greece, and Spain. I know Ireland is not in the south, but it was kind of in the same fiscal situation. And silver that year, when that crisis started, 2011, went to 50. So that's why I mentioned silver. The JGB market, that's the Japanese government bond. I've been covering it for years on my channel, that eventually all the debt and liquidity created by the Bank of Japan and all the debt that's been taken by the government there is going to come home to roost. We've been told by the Keynesians and mainstream economists that Japan has always been in a danger of deflation. But in the last 12 months, I think rice prices went up 100%. So the public, they're starting to feel the pinch. They know that deflation is really not there. And by deflation, I mean falling prices. I know that deflation is the collapse of the money supply, but things get confused a little bit. But now in Japan, the long-term yields for JGBs are spiking massively, and they could spike even more starting this week, because we had an election this past weekend in Japan, and the the government lost its majority in the upper house, and that's quite serious because of the opposition. They want more fiscal stimulus, they want more tax cuts, and the Ministry of Finance and the Bank of Japan, they're trying to rein in all the this money printing and liquidity. So this is throwing a spanner in the works. It could spook investors, and JGB yields could rise even further. And that weakness and drop in JGB prices could spread to treasuries and other government bonds like the gilts and the European government bonds. So that's why I think it's very important to keep an eye on silver and Japan.
Registered silver stocks in COMEX warehouses have declined by over 70% since their 2020 peak, creating what many analysts describe as the tightest physical market in decades. Seasoned investor Mario Innecco notes that COMEX silver inventories are at record lows, and gold futures open interest is falling, showing reduced public participation. He adds that SLV shares are hard to borrow, with lease rates spiking, which signals growing pressure and a likely continuation of the silver squeeze. The commercial silver market, which governs price discovery for 1,000-ounce bars and COMEX futures, is exceptionally tight. Only 600 million ounces of float exist globally, far below the 3.6 billion ounces of total above-ground supply. This imbalance is exacerbated by institutional accumulation in ETFs like SLV, which now hold 600 to 700 million ounces. Mario Innecco says Russia's new St. Petersburg Gold Exchange aims to challenge London's paper-based price control. He believes countries like Russia and China want real physical markets, not speculative ones like LBMA and COMEX. Russia already has its gold exchange at the Moscow Stock Exchange, which has a large physical metal trading section, used by both banks and the central bank. The duplication of the exchange in St. Petersburg will also be open to BRICS countries and their traders, creating an alternative to Western markets. As has been noticed by other central banks, these markets have demonstrated their ability to both freeze and sell assets that do not belong to them. Let's get back to the interview.
I mean, I worked in the futures market for 20 years, mostly trading government bond futures and interest rates. And I did follow gold futures and silver futures quite closely once I started buying gold in '02. But I mean, I don't follow the data very closely. A lot of people do, and sometimes I look at what people say. But one thing that seems to be happening that I think is quite important is that the supply of physical silver in the COMEX warehouses is dwindling, and it's at record lows. I think 155 million ounces. And what you need to understand is that the COMEX itself doesn't have like a warehouse. They just say, oh, this warehouse owned by JP Morgan or whoever, that is qualifies as a COMEX warehouse. So I think that's an important aspect of things. And I've noticed as well, I don't know how it's developing right now, but that open interest in gold futures is dropping a lot. Open interest means that the higher the open interest, the more the public is involved in the market. So it looks like people are not getting as involved. So yeah, and I've seen recently as well that the SLV, which is the ETFs for silver, I think it was last week and today as well, you can't borrow shares from the SLV. And why would you want to do that? Well, I think the bullion banks, they did that with PSLV a few months ago. If you remember, if you remember it, they were borrowing the shares to sell the SLV to keep the net holdings of SLV like neutral, because there are a lot of people buying PSLV, and the trust had to buy physical. So if the swap dealers or bullion banks were able to borrow PSLV and sell it, it neutralized that increase, so they didn't have to buy physical. So they're trying now, I think, with the SLV, but the problem is they can't borrow. The lease rates for SLV shares has gone through the roof. And I think that squeeze in silver is going to continue. And today, as we speak, gold is tested 3,400 again in the spot, and we're close to 39 again as well in spot silver. I read something about this new exchange in St. Petersburg, and the Russians. They know what's going on because they say London controls the market now, even though the UK doesn't produce any gold. And the reason they can control it is because sovereign countries are daft, or I don't want to say, or stupid enough to leave all their gold with the Bank of England. That's how they do it. And basically, the Russians are saying, we're not going to leave our gold with the UK, and we produce the most gold. We're going to have our own market. And I think that's going to chip away even more at the paper games on LBMA and COMEX, because COMEX and LBMA are kind of linked. They're attached at the hip, I would say, and their objectives is not really to have a physical market that functions for physical delivery. Yes, sometimes big actors take delivery in London, but for us, the public is just supposed to be something, to speculate on. But I think the Russians, they're more serious about having a real physical market. And yes, this is just going to continue to chip away at the West's, and especially London's, control of the price finding mechanism. And Shanghai, they're doing the same thing. Shanghai Gold Exchange, they're opening also depositories elsewhere. So yeah, I think the trend is for more and more real physical gold and silver trading. And I think the Russians are very much aware of the paper game. And why do I say that? Well, because there was a summit, I think it was in the Yukon 2005, organized by GATA, and they had like a economic advisor to President Putin who went there, and he found out about all the bullion bank paper game in gold and silver, especially as it pertains to JP Morgan and the bullion banks. So I think the Russians are aware of this, and so are the Chinese, and they know that the Achilles heel of the Anglo-American empire is the fact that they've kept their currencies inflated, and like they've kept the perception that they have value by suppressing gold and silver. So yeah, it's interesting times, and I think they might even open other exchanges. Who knows? Well, I think it just creates a lot of uncertainty, and I've said this in the past. The reason why the US is running such huge trade and current account deficits is not because other countries want to like rip them off. It's because America is running on a credit bubble, and it has been doing that virtually ever since Nixon closed the gold window. They've had the exorbitant privilege to just print dollars out of thin air, while the rest of the world has had to earn dollars and work for it. So, but I don't think it's going to get any better, Jesse, because I don't see Trump or Bessent talking about reining in the Fed, maybe abolishing the Fed and bringing back sound money and allowing the free market to basically iron out all these credit booms and busts, because that's what happened in the 19th century. And overall, the U.S. had like a balanced trade because there were no central banks from 1835 to 1913. But as I said, it looks like now Bessent and whoever's going to be nominated as the next Fed chairman, they want to join up with the Treasury and pump things up even more. I mean, we're supposed to be in a great economy in the US, but they still want to cut rates down to 1. It doesn't make sense. So that's how I see tariffs. They're just a distraction. They're not going to solve anything. I think the only way this problem is going to be solved is through a major collapse of everything. And then people will have to sober up and and not just Americans here in the UK as well. We run big trade and current account deficits. Maybe not as big as the US, but yeah, we'll have to sober up. We'll have to start working and producing and earning our keep in the world. And that's how I see it. As for the sanctions, they haven't really worked that well, have they? All the sanctions against Russia or other countries. All it's done is made them even more determined to create an alternative to the G7 or to the West.
Silver's strategic importance has gained formal recognition, with both the European Commission and the U.S. Department of Energy including it in their assessments of critical materials. The European Commission's 2023 Critical Raw Materials Act explicitly identifies silver as essential for the clean energy transition. This designation reflects growing awareness of silver's irreplaceability in key technologies. Unlike some critical materials that face supply concerns but have potential substitutes, silver combines supply risk with limited substitution possibilities. Given the potential for a short squeeze and the structural supply deficit, investors should consider allocating a portion of their portfolios to silver, either as a standalone asset or in conjunction with gold. A 5 to 10% allocation to silver could enhance portfolio resilience amid macroeconomic uncertainties. Silver's recent rally has improved its ratio with gold to the strongest level in 7 months. It currently takes 87 ounces of silver to buy an ounce of gold, compared with 105 ounces in April. As central banks and major investors pivot toward physical assets and new silver exchanges emerge to bypass Western control, are we witnessing the first real cracks in the global fiat financial system? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.